Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500, and we're just going to be discussing some of the seasonality related to it. Back in July, we mentioned that we would likely get a substantial correction. I think we said maybe like a 5 to 10% correction or so in August/September of the pre-election year. That does seem to have occurred. And now what we want to do is we just want to take a look at what does seasonality tell us about the rest of the pre-election year, but also remind ourselves that sometimes certain events can sort of take you outside of what normally occurs during that season of the cycle. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. So back in July, we made several, we talked about the equity market quite frequently, and we said that one of the reasons that Bitcoin typically gets a correction below its bull market support band in August or September of the pre-halving year is thanks to a correction by traditional markets, equity markets, that can be somewhat substantial. And you can see that the S&P since July, right, if we draw this out, since July, the S&P ended up dropping about 8.5%, okay? Now, that correction is actually substantial, right? It is substantial, and it's arguably more substantial than what we normally get in pre-election years, right? Like 9-10% corrections, that's a lot for, for equities to drop. But what I think the thing that we should focus on more is to look at if we take inventory on what occurred earlier in the year, then it might put this correction more so into context, okay? So this is, again, I'm sure you're familiar with this. This is the year-to-date ROI of the S&P 500 every year going back to 1928, right? So it's obviously a hot mess when you look at it like this. But if we just take a look at 2023, we know that we can, we compared 2019 to it, right? We said, hey guys, we tend to get a correction during this time frame. And you can see how, 2019, there was a correction here in August, and then there was another one in September. Now, one thing to note is that in 2019, we had the August correction. The September correction was a higher low, right? It was a higher low. In September, we ended up just sort of putting in a lower low, right? We got a little bit of a bounce, but it ended up just being a lower low rather than a higher low that we got over here in August and September of the last pre-election year. If you throw up 2015 onto the screen, you'll see that we had that sort of that first correction and then another correction, and it was sort of just another higher low, right? It was a low and then a higher low. If we look at 2011, you'll see a low and then a lower low in September. So sometimes we see higher lows, sometimes we see lower lows, but there's often this sort of this 1-2 punch, right? This correction that occurs in August and September of the pre-election year. And sometimes you get sort of a lower low, sometimes you get a higher low. If you look at 2019, when we got a higher low, we ended up putting in new highs later on that year, right? So the S&P went to go put in new highs. If you look at 2015, it was a higher low, and the S&P made it back up to the prior yearly highs, but it didn't really go much beyond it, right? And it didn't really make it to it, but it got pretty close, right? It got pretty close. And then if you look at 2011, again, we did not really get back up to the yearly highs, right? We did not make it back up to those levels. And we could, of course, go through, all the other prior pre-election years and just kind of look to see other similar patterns. But what you'll notice is that there is a reason to believe that the high that we put in over here in July could in fact be the yearly high. And we talked about that, back then, that this could in fact be the yearly high. In pre-election years, you will sometimes see a rally into the end of the year on average, but it does not always result in new highs. If you were to look at the average of all prior pre-election years, on average, you can see that we do put in new yearly highs by the end of Q4, right? By the very end of Q4, on average, we do put in new highs, and you can see that there tends to be a one correction in August and then a little bit more weakness later on in September. But on average, there'll be a little, there'll be a little bit of sort of consolidation, and then there can be a move up into the end of the year. But what's fascinating is while this correction has been larger than most corrections we get by the S&P, it's actually only brought us to where the S&P normally is at this point in the pre-election year. So that might explain, to some people, like why the bond market fell during this period rather than went up. And we talked about this before, right? We said we're likely entering into a window where both stocks and bonds fall. We said this back in July. I mean, at least I know I posted about it on Twitter. I think I mentioned it in the video as well. But we're likely entering into a period where both stocks and bonds fall, just simply because, because the stock market falls doesn't mean that the bond market has to go up, because it does not always act as a perfect hedge, especially during inflationary environments. And we also saw the bond market fall as well. So the S&P has now dropped a considerable amount. If you look at the average year-to-date ROI of the S&P at this point in pre-election years, the average ROI at this point is about 11%, and that's exactly where we are. The S&P is up about 11%, which is where it normally is at this point in pre-election years. And, you can look at this and see how there can be a significant amount of consolidation, and there can be a little bit of a move higher up later on in the year on average. But it also is important to note that there are sometimes exceptions to the rule. For instance, and again, like when we talk about exceptions to the rule, we're not saying that it's the most likely scenario. We're saying that the most likely scenario usually is to follow more or less what the average is doing. But there can be outlier years where something completely different happens. It's like if you were to look at all post-election years, right? So if you think about post-election years, let's take a look at that really quick so you can kind of understand what I'm talking about. So post-election years, this is what the market looks like. Okay, so when you're looking at it, you're thinking like 2001, 2005, 2009, 2013, 2017, 2021. So if you follow crypto, right, 2021, 2017, 2013, these years probably mean something to you. But when you look at, say, 2001, the market went down that year a lot. So we don't always follow the average path. It's just that that's the most likely outcome. But sometimes you get recessions. And right, when you get a recession, it changes, of course, what you're going to see that year if you get a recession. But on average, right, you'll see it play out in a fairly similar fashion, right? If you look at like 2013, we generally trended higher. If you look at 2017, it was generally trending higher. If you look at 2021, of course, it was generally trending higher. So on average, those post-election years tend to do pretty well as long as you don't get a recession, right? Now, here's 2023, and we showed all prior pre-election years on the average of them, right? Here's an exception. Here's 1987, right? So here's an example where, had you gone into it thinking that, all right, well, we got our August correction, we got our September correction, and okay, now we're going to go up into the end of the year. Look what happened, right? I mean, the market just plummeted in October. So remember, it's important to be prepared for all scenarios. And I know a lot of people want to know just like what's going to happen, when's it going to happen? How much is it going to go down by? Look, no one knows. I don't know. No one on YouTube knows. No one anywhere knows, of course, exactly what's going to happen. So you should be prepared for these outcomes, even if they're not the most likely outcome. So that on the off chance at some point, if it does happen, you at least have some cash to take advantage of it. Unfortunately, there are, fixed income investing is at least a little bit more attractive today than it used to be. So there is at least a little bit more of a reason, I guess, to have some cash in case something like that were to happen. But again, this is the 1987 move, which saw the S&P drop quite a lot, in fact. And honestly, I think what would be more worthwhile to look at is actually comparing, say, like the Dow back then to the NASDAQ today, right? Because the Dow, if you were to go back to 1987, I just sort of look at what was going on, that's what I mean. It basically went up over 40% by August, and then it sort of came back down, and then it dropped going into the end of the year. And you can see this time that the Dow is barely off the lows, right? So it's not even a great comparison to compare the Dow today to what it was doing back then. But look at this picture here, right? This is the Dow, 1.4x correction, and then October, November wasn't really that great. Again, I don't think it's the most likely outcome. I'm just showing it to you because it is a outcome that we should talk about, and we're going to talk about other outcomes as well that are more bullish. But again, this is about a 40% move off the low, and then October came and it was not that great. If you were to look at the Nasdaq, that was 1987, of course. If you were to look at the Nasdaq and look at where we are this year, right? It's about 1.4x up, right? I mean, it went up 1.4x, not that dissimilar from what we saw back with the Nasdaq. Now, 1987, the Nasdaq. This is what the Nasdaq did in 1987, right? I mean, it rallied for a good part of the year, and then we had a fairly substantial drop, as we got into Q4. But we know that on average, that is not what normally happens, right? Like on average, looking at prior pre-election years, the Nasdaq slowly trends higher. I think the one thing to consider here is that, it is on average, right? We've gone up a lot more than we normally do, just like we did in 1987. But in 1987, we also actually went higher than where we were today. Okay? So just something to think about. I'm looking at this, I'm looking at the S&P, and I try to look for patterns to figure out, okay, well, what is the most likely outcome? My opinion is that, we likely will eventually go into a recession. I don't know exactly when that's going to be. I've said for probably well over a year now that the recession could materialize at the earliest, I've said, into 2023. Right? So now we are getting into the end of 2023. So I at least want to be on the lookout for that potential outcome. I also know that it might not occur until next year as well. When you look at the S&P 500 and kind of just look at what it's doing today, I mean, at least it's trying to hold these lows. I mean, again, you could have made the same argument many, many times. So far, the current low is occurred on October 3rd. Okay. And if you look at 2019, actually, this correction ended on October 3rd, and then it sort of rallied, and then we got a recession. Now, I know a lot of what people might say is like, well, that was a pandemic. There's no reason you should compare to that. And maybe they have a point. But sort of the counterpoint is that we also had an inverted yield curve, and it became uninverted, and then we something happened. The economy was sick, and then we ended up getting a recession. Yes, we can always come up with a narrative to explain it. And again, I'm not trying to dismiss that it is, to some degree, right? I mean, that is a black swan event. But I think the other thing to remember, too, is that if something like that were to happen again, right, everyone would just say, well, there's no way to predict it. It's just a black swan, right? When even though you've had an inverted yield curve for, about a year now, we've had all these sort of warnings that say, hey, it's probably going to happen. If and when it does happen, it'll just sort of be written off as a black swan more than likely. So you can see that what happened over here, right? I mean, we put in a low in August, we put in a low in September, in October, and then we rallied into the end of the year, and then we got our recession drop, which took out this prior low. So I mean, like, imagine if you had been living through this entire market, you would have seen this low, this higher low, higher low, higher low, and then of course we ended up putting in a lower low eventually. And that is, and we've talked a little bit about this, but if you were to look at the jaws of liquidity, so we've talked about this before, but this is the net liquidity model that we have here, and you can kind of see how I think the argument here is that the S&P can always the jaws can close, right? So the jaws can close if given enough time, and then it's not until net liquidity really starts to move higher that the S&P more so sustainably takes out these prior levels, right? So like this was a low, but then we ended up closing these jaws of liquidity that opened, right? The jaws of liquidity opened over here, and then they eventually clamped shut, right? The jaws opened again, and then eventually they clamped shut. And then if you go look at what's going on today, right, you can kind of see the same thing where the jaws of liquidity have opened here. And then the question is well, are they clamping shut now? Are they? I don't know. I mean, I certainly couldn't tell you. Um, I do know that at some point, or at least I think I know, right? I think that at some point they will clamp shut. But who's to say if it'll happen now, or who's to say if it'll happen next year, right? I mean, back over here, once we got this rally off these lows from late 2018, the jaws did not clamp shut until until 2020. Okay, and so will it happen this year, or might not happen until 2024? So there is that October seasonality, right? And you can actually see that not just last cycle as well. I mean, like you can see that it there was a local low found here in October 2019. If you go to 2015, right? So if you go back to 2015, you'll see that there was a sort of this local low found in early October, right? If we were to zoom in, I believe it was early October. If we get the exact date, it was actually September, so it was late September, September 29th. Another local low was found. We then rebounded up into the end of the year. We did not put in a new yearly high, right? We did not, and then we ended up taking out the September October lows in early 2016, right? In early 2016. So what's interesting is you'll see a lot of familiar periods of weakness. Okay, so let me show you what I mean. So like this cycle, there's a low here in October of 2022, right? And then there's sort of this higher, there's another one in December, and then here you have it in March, and then August, and then September, well, really October, August and October. You very similar periods over here, right? Where there's a low in October, a low in December. It was a lower low, but it doesn't tell you if it's going to be a higher low or a lower low. It just sort of tells you when there's a period of weakness. But these months sort of line up, right? I mean, you have right here, just like, over here, we also sort of had this low right here just before we sprung up, right, in June, late May, early June, sort of corresponds to that one. Here's August, here's September, August, September, and then of course we saw a pretty significant rally after that into the final low that occurred in the early part of in the early part of the election year. If you go sort of before that, you'll see other periods of weakness, right? Like October 2014, right? And then we saw it come back down in December. And then here, this is that August, September timeframe. And then you got another area of weakness in the early part of the election year. So it's interesting how this stuff lines up. And that's why we talk about seasonality. It's not to say that it has to happen, right? It's not to say that it has to happen. And here's the NASDAQ, just since we have it pulled up. Let's add the average. So we already have the average of these pre-election years. It's never to say that it has to happen. It's just that it normally does, right? When you look at the S&P, it's just that it normally happens. And that's why, when we put out these videos back in July, I saw a ton of comments from people, especially a lot of people who were very bullish and were riding the bullish wave. They were like, no, there's no way it's going to go down. It'll just be consolidation, right? It'll just go sideways until the market, sort of catches up to believing that that's the fair value. It'll just consolidate for a while. An 8 or 9% drop is not a consolidation move, right? That is a significant correction. It is still technically a higher low, but I don't think you can call like an 8 to 9% move just consolidation. It's more so a pretty substantial correction that we normally get in August or September of the pre-election year. So while I know a lot of people sort of dismiss seasonality worked, didn't it? I mean, we got a substantial correction that took the S&P 500 back down to where it normally is at this point in prior pre-election years. And again, on average, if we end the year where the S&P would typically end pre-election years, it would not be that much higher than it is today, which would make me think that it's less likely to take out these prior highs. So there is certainly a decent chance, not 100% chance, right? But there's a decent chance that this is the yearly high. And that would include even if there is a rally coming out of this, right? And I mean, I'm sure we can draw a trend line. I don't know if these connect or not. I mean, just sort of eyeballing it, I'm sure someone might connect the dots here and look at these trend lines. This is a logarithmic scale. I'm not really sure if it looks any different on a regular scale or not. But yeah, so you can connect the dots and see that, we had a low, and then this was a higher low, and then a higher low as well. But I constantly remind myself that there is this sort of this looming inverted yield curve still sort of hanging over our heads. And, it's hard because you can have sort of this view as to where the market might eventually end up, but it doesn't mean it's going to go there right away, right? I mean, there's always the path that you have to deal with. In 1987, it went there right away, right? Like you didn't have to wait that much longer for it to occur. But in 1987, I mean, it kind of just came out of left field. It's not like it was necessarily on the minds of everyone at the time. The market had been very bullish for a long time, and it's not like we had just come out of the same type of macro environment, if you will, right? The macro environment today is a lot different than it was back then. So that's the thing, and I think a lot of people sort of dismiss seasonality because there's like some times where it doesn't work, even though on average it does tend to work. It's kind of like with Bitcoin. We talk about how on average it doesn't tend to do that well in September, and we've made that video, like 3 to 4 years in a row, and 3 Septembers, red, 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 and then we get one green one. And so then people say, well, that seasonality doesn't really matter anymore because it was green. But it's like, well, yeah, it's not going to always work. It's more so based on probabilities. And in this case, the seasonality of the August to September correction did pan out, right? We got a substantial correction by the S&P over the last couple of months. Now, with that said, I mean, if you look at say like the fear and greed index that we have for for traditional markets and whatnot, we are at pretty fearful levels. I do remind myself that oftentimes from fearful levels the S&P will bounce, right? Oftentimes. There's also a lot of times too, well, maybe not a lot of times, but sometimes crashes occur from fearful levels, right? So that's the other point to remember. I will say, if you're curious what my strategy is, my strategy is pretty boring. I just DCA at risk levels that I'm comfortable with. So like the lower the risk, the more I'll DCA. The higher the risk, the less I'll DCA. And if we go to a too high risk level, then I won't put anything into the market. Okay, just because it'll just be too high risk for me. So, if you're thinking that the recession is not going to occur this year, then this low, I imagine, would be somewhat attractive, especially looking at what happened in 2019, right? This low would be somewhat attractive. If you think the recession materializes this year, then it wouldn't be as attractive, right? I mean, what if we repeat a 1987 type move, right? And I don't know. I mean, I'm sure there's some other scenarios that we could look at that might. I believe there was a few. I mean, we don't have data going back, obviously, forever. Yeah, I know someone pointed out to me earlier that this in 1929 October was not a great month, but again, this is these times where like seasonality can often play out, but it doesn't always have to. Like here's an example where you got sort of this correction into August. We got a little pop up here in October, and then we still ended up going down as we sort of got into the end of the year and the following year. So that's why I think it's important to be careful of that. Now, I want to elaborate some on sort of the recession idea, because when is it going to come? I mean, this is one of those things that people keep predicting, and some people say it already occurred in 2022 because we had 2 consecutive quarters of negative GDP. I'm not in that camp because you don't really call it a recession when you're at historical 50-year lows in the labor market. You would think of a recession as people actually losing their jobs. So I've actually been pretty adamant for a long time that we're not in one. But that doesn't mean that we won't go into one, right? It doesn't mean that we won't go into one at the end of the business cycle. And there's this interesting thing we can look at. So we could look at a few different metrics, right? So this is the metric performance after inversion of the 3-month to 10-year yield. Okay. So if you're not familiar with what I'm talking about with yields, take a look at the yield curve, right? So let's go take a look at the yield curve. So here's the Treasury yield curve. And what you'll notice is that it's inverted. And the reason why that's important is because, well, before other recessions, we'll have inverted yield curves, right? So you can see how it becomes inverted and then it becomes uninverted at some point, and that's where the recession occurs. Same thing over here during the dot-com crash, right? We had an inverted yield curve. As you can see, it forms right here, and then we came out of it and we went into the recession. So we have an inverted yield curve today as well. And so the question is well, when is it actually going to lead us into a recession? Oftentimes, we don't go into a recession until the uninversion of the yield curve. right? So the uninversion is typically the higher, the high risk area, right? Like this uninversion here, this uninversion here. You can see this gray shaded region occurred after the uninversion of it, not before. All the recent ones, right? In 2019 to 2020, the one from, the financial crisis, the dot-com crash, the one from 1989, right? All of the recessions in recent history occurred after the uninversion of the yield curve. If you went back to 1980s, you'll see that we actually had some recessions here while the yield curve was still inverted. And what's interesting about that is it's actually somewhat similar to today's macro, considering that inflation is high. I don't know that everything's not the same. There's also a period in the 1940s where we had high inflation as well. And so that's, that might be another analog to compare to as well. But once this becomes uninverted or is in that process, that's where the risk is the highest. And you can see that it is getting close to uninverting, but it's not because the short end of the curve is going down. It's because the long end of the yield curve is going up, right? That's why, treasury yields have gone up substantially in just a short period of time, right? Like the 30-year was basically, I believe, at like 5%. It's off that high right now. The 10 years at 4.7%, right? So you can see TLT has absolutely taken a plunge, which is what we talked about. And we talked about this many times, that the bond market would likely show weakness as the market eventually starts to price in higher for longer. Okay. So, this is the spread on the 3-month and the 10-year. We can also look at it on the 2-year and the 10-year, which is what a lot of people care about. And you can see that also is starting to sort of come back up into these levels. So the thing is it might be worthwhile to compare how the S&P, or not necessarily just the S&P, and we can look at that too, but how various metrics performed after yield curve inversion to understand what might actually lead to a recession or when a recession might actually occur. So this shows total non-farm employees ROI to low after the inversion of 3-month and 10-year. So this light blue line is what we are currently doing in 2022. It's outperforming a lot of the prior cycles so far, right? But in other cycles, we can see that oftentimes it went up for a while and then eventually it rolled over. The financial crisis took, almost 2 years to roll over. And it was a terrible bear market, right? It was a terrible bear market. So this is one metric, but there's some other interesting ones that we could look at as well. Maybe we can look at the coincident economic activity index. That might be an interesting one to look at. We talked about that one a little bit. You can see right now, and maybe we'll just hide what happened here during the pandemic so it looks a little cleaner. You can see here's 1981. It went up for a little bit and then faded. This blue line is the financial crisis, right? You can see how long it went up before it started to fade. And then this one right here is the current cycle. So, the context of history shows us that, just because a recession hasn't occurred yet doesn't mean that it won't, right? Look at what happened during the financial crisis. Look how long we had look how long this index held up before it finally rolled over. This yellow dot represents when the yield curve became uninverted, right? That's where it became uninverted, right here in that cycle. And you can still see that the coincident economic activity index still went up for another half a year or more before it finally rolled over. And there's, of course, other interesting ones to look at. You could look at like real GDP, might be something useful to look at. And you can kind of see where we are in this cycle. This is 2022, this top one. So it's performing pretty well so far, right? One of the reasons I think it is, though, is because we actually got 2 consecutive quarters of negative GDP in 2022 before, we really had all this inversion of the yield curve and stuff. So it was also coming off of some lower levels than it normally would have. Just interesting ways to look at the market. But the other way to look at it is to actually look at the performance of the S&P, right? Actually look at the performance of the S&P and see what was going on after yield curve inversion. And this is what it looks like, right? There's a lot of different cycles you can compare to. This is the current cycle. This is what the current cycle looks like. This is not from the high of the 2021 high or anything like that. This is just simply from yield curve inversion of the 3-month and the 10-year yield. Now compare this to the financial crisis and look to see what happened, right? So this is what I look at because I'm like, I tell myself, just because we haven't seen the labor market weaken, it doesn't mean that it won't. it just is going to take time, right? It's taking time for the Fed to achieve their objective, and they want the labor market to weaken. So I look at this and I think, like, imagine these guys that were investing over here. This is where the yield curve became, uninverted. But just imagine if you were sort of in this cycle, living it, and this still happened, right? But we can look at other ones. We can look at the dot-com crash and kind of see where it went. That one was much more bearish, right? It was just mostly down. There's 1989. This is what happened in 1989. The S&P 500 ROI to low after inversion 3-month and 10-year yield. Right? Rallied for a while, up to about 1.16x off the where it started. This cycle, we're up 1.19x at these highs. Still eventually rolled over and put on a new low. Right? 1981, 1982. Here's 1979 to 1980. Pretty interesting one to look at, right? After yield curve inversion. Followed it pretty well for a while, right? But in that one, it reached this point and then it plunged. So this is where that seasonality can sort of make it somewhat foolish, because we can look at all the seasonality in the world and say, hey guys, this is what's likely going to happen. But you should know that if the recession materializes, then it doesn't really matter what seasonality is, right? I mean, anything can happen. So when we talk about seasonality, when we talk about the August to September correction that we ended up getting, so we were right on that. There's no guarantee that we would have been. There could have been a scenario where we just rallied in August and September, and that projection could have easily been wrong. So just because it panned out doesn't mean that all seasonality projections will pan out. And the longer you watch that channel, this channel, you'll see that we talk about seasonality to say this is the most likely scenario. Doesn't mean that it has to play out. Here's 1979 to 1980, so you can kind of see it was tracking, and then eventually it plummeted. Here is 1974, not very interesting. 1973. Here's 1969, kind of an interesting one. So that's what we're looking at, right? That's where we are. And it might also be interesting to look at it with the 2-year inversion of the 10-year. Because when you look at it like that, here's 2023, here's the financial crisis, right? It's actually kind of eerily similar at this point. But here's the thing with analogs is markets tend to trend up, right? They tend to climb the wall of worry. So if you overlay any of the analogs, they're all going to look very, very similar, right? Because the market just sort of slowly goes up until it has a reason not to do so. And the reason normally is the labor market, right? I mean, it could be a geopolitical event. It could be high inflation like it was in 2022. But again, the markets generally trend higher until they have a sufficient reason not to do so. And again, it's usually because the labor market starts to go. So you can compare it to the dot-com crash. You can compare it to 1989. Here's 1982, 1980, 1981, and 1978. Here's min and max. Looking at that. So you can kind of see we're still in that window. There's other things we could do. And again, this is sort of going to be dependent on whether you think the bear market is over or not. So if you were to go over, look at just sort of the ROI of the S&P during prior bear markets, and maybe there's a few that we can look at. So this is the current one, and of course this assumes that the low is not already in. If the low is already in, then this will just be retroactively made to sort of end here. There's no way to know at this point. And I know there's a lot of people out there that'll just say very, very confidently that the low is in or the low is not in, but there's just simply no way to know, right? There's no way to know, and the low could be in for a year before a new low is put in, right? Who knows? Look at what happened in 1946 to 1949. Look at this. I mean, we had a low here at around the year mark. So not that different from 2022, right? We had these lows put in. And then another low wasn't really put in. So this was on day 355. The final low wasn't put in until, day 1111, basically. Interesting, right? 1111, right? But think about how much longer that was. You're talking about basically another 2 years before that low was taken out. And imagine how many bulls and bears just spent arguing for 2 years over here whether the low was in or not. And for a new low to come for the bears to celebrate victory that they were right and to then probably declare that it's going to go a lot lower, only for then that to mark the bottom, and then the S&P just trend up like that for the next several years, right? So that's why it's difficult, because you know, you can always put in a new low, but it can take a long time to get there. And this cycle it's worthwhile to compare to 1946 to 1949, because we came out of World War II. But the reason is not because we didn't come out of a world war, but we just spent money like we did, right? If you think about the pandemic, there was a lot of spending, just like there was back in World War II. So we had a period of high inflation, right? And so when you look at this chart, there are similarities, of course, right? You sort of scrape the lows for a while, you get a nice rally. If this does end up being a recession, then maybe this is just sort of the slow fade into a recession, right? Maybe we're in it right now and we just don't know it, where you maybe get a bounce in October and then it just kind of slowly fades as we get into early next year. So that's something to consider. And it would be interesting if we did put in a slightly lower low, because then that would correspond to, you know, the 2019 the pre-pandemic high, I believe. So that is an analog to compare it to. If you compare it to, say, 73 to 74, another period of high inflation, you can see that we've kind of diverged from that. But, you know, at some point you can see we sort of entered into this downtrend and it just kept going down for quite a long period of time. And there's other ones we could look at, right? And we could look at 1961 to 1962. There's 1966. This one's 1937 to 1942. You can see how long that one took. A really long time. This one is 1987. See, this is the one where, you know, you basically just got a 20% drop overnight. It was crazy. Here's 1990. Here's the dot-com crash, right? So you can see where we are in relation to the dot-com crash, and so on and so forth, right? Again, I'm just here to show you all these different comparisons so that you can make your own decisions. I don't offer financial advice. I just want you to look at these charts to kind of understand like what could be going on, and the whole recession stuff. I mean, it's sort of one of those things where, you know, people have been talking about it for so long that by the time it actually happens, no one really believes it. But you should understand that oftentimes after yield curve inversion, you don't have an immediate recession. And, you know, I feel like we've been saying this for a year now. You don't typically have an immediate recession during yield curve inversion. It's normally after the uninversion, or at least the uninversion process. If you go back to the 1980s to see what happened, right? So we must remember that there are lag effects associated with that. So that, you know, that's what we're looking at here, right? From a pure seasonality perspective, October, early October, late September has offered a low that we have seen some rallies from. We can also compare to 1987. We can look at recessionary years and see that we throw seasonality out the window when that occurs. So a lot of it, I think, just sort of comes down to whether you think we're going into a recession or not, right? If you don't think we're going into one, then I imagine you would be a lot more bullish about sort of these higher lows, right? If you think we're going into one, then it still doesn't mean we can't bounce, right? We could always bounce and then sort of fade back down. It is interesting because, you know, if we do bounce in mid-October, it might actually correspond to the dollar getting a perhaps much needed correction, right? And I mean, you guys follow me, you guys know I've been bullish on the dollar a lot, and there are a lot of people bearish on it. If you remember back over here, a lot of people were calling for, you know, the dollar was just going to plummet. But look at this. I mean, this was sort of a Wyckoff accumulation, and now we're in our 12th green week, right? So if you look at the dollar over here in 2014, we had 12 green weeks in a row, and then we had a 2-week correction, and that 2-week correction came in October, right? It came in October, and then the dollar continued up later on. So if there is a 2-week correction by the dollar in mid-October, right? So let's just say, you know, we get some type of correction by the dollar sometime the next few weeks, that could lead the S&P to see some form of a bounce, right? And a bounce, if it does materialize, I think the major area to look at would be the bull market support band, which is currently at around 4347 to 4400. So around that 4400 level. And it's interesting to note that this high here was at 4600. This high here was at 4500. So if there is a bounce in October, then that 4,400 level is probably going to be the level to really pay attention to, right? Because that is where that 20-week SMA is starting to roll over, right? That 20-week SMA is starting to roll over. And if the S&P gets rejected there, then you could have then that recession narrative really might start to take effect. So I would be looking for that if a bounce does in fact materialize. The other thing to look at is on the daily time frame. You can look at the 200-day. We're not that far from the 200-day. So whether this is a local low or not, if we do sort of come back down a little bit more, the 200-day is actually right around 4,200. So that would offer some form. I'm sure some people would come in to buy there. That's also sort of this prior high, this 4,200 level. So I would be looking at that as well. We've already gone, well below the 100-day. The 100-day is actually closing out on 4,400 as well. So again, that's that 4,400 coming back in. So if we do see any type of a bounce in October by the S&P, again, that 4,400 level I think is going to be sort of the line in the sand to keep your eyes on. And if it does offer some form of a rejection, just remember that could just lead us into further consolidation like we would normally get in October and November of pre-election years. A lot of times the rallies that occur, of course, 2019 went up almost immediately, but a lot of times the rallies that occur after a seasonal correction only come after another month or so of consolidation, and then on average the market trends higher into the end of the year. And if you're not familiar with what I'm talking about, let's just go back to it really, really quickly because I want you to sort of see what I'm seeing. Going back to the S&P 500 and looking at prior pre-election years, on average there is some consolidation, right? Like, so if there is a little bounce back up, it could just lead to, it could even lead to another lower low, right? Or scraping those lows for a while. Okay. So, and again, the reason in 2015 that we didn't really go up that much more is because, we sort of were dealing with a recession and a recession scare, right? And you can see what happened in early 2016. The market dumped another 10% or so. So that's kind of where we are. I think I've covered mostly what I wanted to cover. Just understand that seasonality plays a role, but it's not everything. Seasonality came to the rescue here, right? It told us that we likely needed to see a correction. We got it. Now the question is that it? Or is there more? And that's what we'll just have to see how the S&P plays out here over the next few weeks, and whether that recession risk materializes or not. We're going to get unemployment data relatively soon. We do know that some of the employment data hasn't really been that great recently. So if we were to look at, I want to look at non-farm. Yeah, this one's there. Yeah, so total non-farm. So coming out of the ADP, we got the Automatic Data Processing Research Institute. If you look at this, that's a pretty weak print. Like if you sort of zoom in on it, like we were moving up pretty well for a while, right? And it seems like it's starting to round out potentially. Now, one data point doesn't really make a trend. We need another data point. We need to see what happens next month. And if you can't see it, like look at the month over month change, right? And let's look at the month over month percentage change. Look at where we are. 0.069%. This is the lowest monthly change that we've seen this cycle, right? All these you can see it's kind of been slowly trending lower. This is a pretty low print. Look at the year over year change on this. At some point earlier, right, when the S&P was doing well, you can see this was starting to curl back up, right? So that year over year percentage change of total non-farm was starting to go back up, and so too was the S&P. But now the S&P is starting to go down, and so too is the total non-farm year over year percentage change. So the labor market is starting to show some signs of weakness, especially with this most recent print that we got, right? And it makes sense. If you look at like job openings, we got a pretty hot print this last a few days ago, right? But is it not just a stochastic process where it's just still slowly trending down? Again, this is one of those things where we've had these moves up. We had one up in December. We had another move up in April. Is this just another move where it just ends up being a lower high? You can clean it up by, say, taking like a moving average, right? So if you just take a moving average, it more so shows you the general trend, and the general trend of this job openings has been down. And the reason why that's important is because if you were to go take a look at at the employment risk. And we talked a little bit about this, but if you were to look at job openings risk, it because of that hot print, you can see it's come down a little bit here. Unemployment rate risk tends to go up after the job openings risk goes up, right? So the green line is job openings risk. It goes up. And you can see here it like went up in March. The unemployment risk didn't really start to go up until July. So it's about a 3-month lag or so, maybe about a 3 to 4 month lag. Here it was not as long, right? Just a couple of months. Over here it was nearly identical because everything happened all at once. And then of course you can kind of see that it is the unemployment risk here is starting to slowly go up, right? Like, I mean, it's not very much, but if you sort of zoom in to it, I mean, you can kind of see it's just off those lows, right? Just off those lows right here. Slowly, let me remove. Right, yeah. So you can kind of see it's slowly trending up, but not a lot. So we'll wrap it up there. We've covered, I think, everything I wanted to cover. So just be aware of seasonality in October, and know that, you know, if and when the labor market really starts to show more weakness, that could lead to the to sort of the stock market starting to make a detour away from seasonality. And by the way, I mean, if we don't detour from seasonality and we consolidate and or trend up into the end of the year, I think the next period of weakness would be, you know, Q1, right? February or March. You know, that March is when we had this low back in the last cycle. And then if you go back to 4 years before that, this low occurred and was a lower low. This low occurred in February of 2016, right? So you have in the election year, you have a low put in Q1, right? A low in Q1 of 2016, a low in Q1 of 2020. Well, we have another low in Q1 of 2024, right? It's kind of like we've talked about the Russell before. I've had this drawn since the Russell was like way over here, like back in like April. I think we drew this out, and the idea is that it normally puts in a low in the midterms year, it then rallies in part of the pre-election year, and then puts in a lower low in the election year, right? 2014 low, and then a lower low in 2016. 2018 low, and then a lower low in 2020. 2022 low, will it lead to a lower low in 2024? Let's wait to find out. Anyways, if you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out Into the Cryptoverse Premium at intothecryptoverse.com. We, of course, have a lot of these charts that we've been showing. You can get access to them and look at them, you know, whenever you want to, rather than waiting for me to make a video about them. You can track them in real time and or at least on a daily basis and see what's going on with these different metrics, and hopefully it'll help you navigate the equityverse a little bit better. I'll see you guys next time. Bye.